Property valuation. How much is property worth? Ultimately, it's only worth what a buyer will pay for it. So the buyer and the market in general determine real estate values. How much will buyers pay? Now that's a tough question. In fact, it's so tricky that there is an entire profession dedicated to answering it. The people who estimate what buyers will pay for real estate are known as appraisers. Their estimates of value are known as appraisals. Appraisals are important to understand due to their relationship to financing and taxes and are governed by the Uniform Standards of Professional Appraisal Practice, USPAP. Per Title 9 or 6. I have 6. Per Title 6 of Financial Institutions Reform, Recovery and Enforcement Act of 1989, appraisers must have an appraisal license to make an appraisal for any federally related real estate transaction secured by real estate, and for any non-secured real estate transactions over $2,500,000 in value, which covers most real estate sales. Therefore, real estate agents can typically only make comparative or competitive market analyses, usually as part of a listing presentation, or give broker price opinions to determine listing prices, usually based on recent sale prices by the square foot. Comparative market analysis. A comparative market analysis, CMA, is a method used by real estate professionals to estimate the anticipated market value of a property by comparing it to similar properties, comparables, that have recently sold. Agents use CMAs to create listings and purchase price ranges so that their clients are informed buyers and sellers. Part art, part science. A CMA takes into account various factors such as size, features, condition, amenities, curb appeal, and sales prices over the past 6 months in a given area. The smaller the radius, the more accurate the value. Generally, 3 to 5 recently sold properties that are of similar size, location, and condition are compared to a subject property, the property being priced by the agent. Adjustments are given to make the comparable properties as close to the subject property as possible, so that the agent can project what the property might sell for. A price range is given to the seller or buyer to help them make the most informed decision when it comes to selling or buying property. CMAs can be used for both residential and commercial property rentals and sales. While every agent's process for doing CMA may vary a bit, the basic mechanics of a CMA are the same. Gather property information, for example, size, amenities, condition, deed restrictions. Define the comparable market area, for example, specific radius, to gather comps, ideally within 1 mile, but vary based on geographic region. Choose and analyze comparable listings, for example, recently sold properties that are similar and possibly under agreement properties if inventory is low. Consider demand and market trends, for example, supply and demand. Determine an estimated listing or purchase range. A report is generated for the seller or buyer client with charts comparing similar properties to the subject property and the agent's recommendation of the listing or purchase price range. MLS, Multiple Listing Service, has built-in CMA tools for creating customized reports with ease, and brokerages may also have branded CMA tools for their agents to utilize. Broker price opinion. A broker price opinion, BPO, is a professional estimate of a property's value that is much faster and less structured than a CMA or an appraisal. BPOs are more informal and heavily rely on an agent's professional experience rather than an in-depth analysis of comparable data. BPOs can be used in a variety of ways, both for listing and purchase pricing. However, they're more commonly seen in foreclosures and short sales. Agents are often hired to offer a BPO when a bank wants to know what price they might get at a foreclosure auction, or the lowest price that they should approve on a short sale. Other uses for BPOs include portfolio valuation, loss mitigation, PMI appeals, and sometimes as a supplementary document alongside an appraisal. BPOs do not conform to US PAP standards and can't be done in place of an appraisal. Automated valuation. An automated valuation model is a software-based tool used to assess the value of residential and commercial real estate. AVM assessments take into account information such as the property's sale history, tax assessor's value, features of the property, and the sales history of comparable properties. AVM uses this data to create a mathematical model which produces an approximation of the property's worth. While AVMs are faster and easier, they are only as good as the data used. So even though there is less human error and bias, they need a large amount of high-quality data to be useful, and they don't factor in the actual value of the property or the property's condition. There are commercial AVM providers such as Freddie Mac or Equifax, and there are also free AVMs available through sites like Zillow. AVMs are often used to support underwriting for loans, refinancing decisions, and aid in credit risk management activities. Agents may not make appraisals or call estimates of value an appraisal unless they are also licensed as real estate appraisers. How an appraiser estimates real estate value. All appraisers follow a similar process. First, the appraiser defines what rights, real estate, and definition of value are being considered. Second, a preliminary survey is ordered, and an appraisal plan is made. The plan might include data, personnel, and time requirements, and a fee proposal. The appraiser then collects information about the general macroeconomic climate, area economic data, specific information about the property in question, for example, title and record, physical characteristics, improvements, and comparative properties, comps, which are local sales, rentals, etc. from the past 6 months. The appraiser completes a highest and best value use analysis to determine if the property is being used efficiently or if it could be put to better use. And finally, the land is valued. The improvements on the land are valued based on the 3 approaches to value below, and the findings from any of those approaches are reconciled. The appraisers weigh each finding and arrive at a final estimate of value in the reconciliation step. The appraiser then reports their estimate of value in either a narrative form, which would be a written report, or via a Uniform Residential Appraisal Report, URAR, or Fannie Mae, Freddie Mac Form 1004. What is value? Value is how much a ready, willing, and able buyer will pay for something and a willing and informed seller will accept. There are many factors that impact an appraiser's estimate of value. The elements of value are dust, demand, D, the number of people that want to buy the property and are actually able to do so, utility, sometimes usefulness. The more useful it is, the more in demand it is, supply or scarcity. The more plentiful something is, the less it is worth, and vice versa. Transferability. Sellable real estate must be free from clouds on title issues with ownership. This is known as having a good and clear title or a marketable title. Real estate with title defects are difficult to sell and thus lower the value. There are several ways to define value for real estate. Market value, the theoretical price a ready, willing, and able buyer would pay, and a willing, informed seller would accept in an arm's length transaction, a sale with no collusion between the buyer and the seller, also known as a fair market value. Market price, the actual amount paid in the market. Value in use, the value to a particular user of a property, for example, farm value versus raw real estate value. Cost, the total cost to build a property. Investment value, the value of a property for investors. Insurable value, value of a property for insurance. The comprehensive loss underwriting exchange, CLUE, records past consumer claims that are used in ownership insurance underwriting. Assessed value, the tax value of a property. Liquidation value, the foreclosure value of a property. The principles of value. Below are some terms that appraisers use when valuing real estate. You will sometimes see these referred to as the principles of value. Change. Real estate values are cyclical and change over time in response to the general economic climate, interest rates, inflation, employment, etc. Anticipation. The benefit a property owner expects to receive over their lifetime of ownership. An example is if someone buys a property for $60,000 and expects to sell it for $300,000. Substitution. Buyers will not pay more for something than they have to pay for a comparable good. As a result, property owners can't charge much more for their property than the surrounding comparable properties are selling for. Progression and regression. The increase, appreciation, or decrease, depreciation in your property value caused by substitution. This means that a home in an area with nicer properties than it will usually see its value increase, progression, and alternatively, if the properties around the home were less nice than it is, then the value would decrease, regression. 4-stage life cycle. Properties go through 4 stages: growth, stability, decline, and revitalization. Balance. The notion that value is created and maintained when there is equilibrium among the amount and location of types of real estate. For instance, a loss in value might occur if there are fewer services and agencies than a community needs, or more services and agencies than a community can support. Conformity. The idea that maximum value is achieved when a property is more or less in line with the surrounding properties. Contribution. Additional investments in a piece of property as measured by the increase in value. Increasing and decreasing returns. Spending money to improve a property may not add value. This is a function of substitution. If you have spent too much, it is an over-improvement, and not spending enough is an under-improvement. Competition. Profit attracts competition. Competition increases supply, which drives down the price down price and corresponding profits. It is assumed that, in free markets, profit will eventually be driven to zero by competition. Consistent use. This principle states that when improved land is in a state of transition to another highest and best use, it cannot be appraised with one use for the land and another for its improvements. Highest and best use. The idea that properties will be optimized to their most optimal use over time. The highest and best use is the most optimal use. Plottage value. An increase in value associated with assemblage. Assemblage. The combination of multiple small pieces of land into one large parcel. Influences on property value. There are also a number of fairly intuitive basic forces that influence the value of real estate. Social trends, people's wants and desires, impacted by demographic trends, family sizes, environment preferences, crime rates, etc. Economic, people's ability to buy homes, impacted by employment, inflation, interest rates, etc. Real estate tends to follow market cycles, characterized by a cycle of recovery, expansion, oversupply, and recession. Government and legal, what you can legally do with the land. The more useful it is to more people, the more it is worth, and vice versa. Impacted by zoning, building codes, environmental laws, etc. Environmental and physical. Location, location, location. Proximity to transportation and highways, natural resources, climate, views, etc. The 3 ways to value real estate. There are 3 basic approaches to evaluating the value of a piece of real estate. There are sales comparison approach, the income approach, and the cost approach. Sales comparison approach. This is the most common appraisal analysis, also referred to as the market data approach, where an appraiser looks at recent comparable sales comps and estimates the value of a property based on those sales. It is most useful for midlife, residential properties, and land sales. Comparable sales should be limited to properties that 1. Are located in the same area as the subject property being valued, and 2. Were sold in the last 6 months. Take a situation where the appraiser is evaluating the value of a 3-bedroom home. In our simplified example below, they find 2 sales that are similar to the subject property, except that they each have a different number of bathrooms. The appraiser would use available pricing data to estimate the value of a bathroom in this area, for example, let's say $10,000, and would adjust the comparable properties to reflect an increase or decrease in value if they had the same number of bathrooms as the subject property. It would look something like this. Obviously, our example is extremely simple. In real life, there would be many more adjustments, and the appraiser would have to do a weighted average of the adjusted prices, where more similar properties are given more importance than those with many adjustments, in order to finalize the estimated value of the subject property. Investment value, the income approach. There are several ways to estimate value of a property to investors. For investors, a property's financials are one of the most important factors when they decide to buy or sell a property. Annual property operating data sheets show the annual income of a rental property. APODs are considered the profit and loss statements for invest properties. Okay. APOD sheet terms. Let's look at the essential elements of an APOD sheet. Gross income, income before expenses, revenue. Net income, income after expenses, profit. Vacancy, empty rental properties or units that do not produce income. Vacant, empty rental properties result in a loss of income since no one is paying rent while the property is vacant. Occupancy is the opposite of vacancy. Operating expenses, the cost to run the property. Operating expenses are things like maintenance, insurance, municipal property management, property taxes, etc., and are usually deductible for tax purposes. Debt service, mortgage, loan,